Welcome back to another Explainer. Today, we're diving into what I can really only describe as a high-stakes financial detective story. We're looking at Sable Offshore Corp, trading under the ticker SOC. If you follow the energy sector, finding the signal through all the noise can be incredibly tough. But the numbers we're going to look at today, they tell a seriously gripping story of immense risk and just incredible potential reward. Just look at this number right here, plus 195.9%. That is the massive upside currently being forecast by some of Wall Street's top analysts. While Sable Offshore is sitting right around $11.83, the high price target is a staggering $35. Even the median target is $24, which implies a more than 100% gain. Okay, let's dive right into this, because it sets up the absolute central paradox of today's explainer. How on earth can Wall Street be so overwhelmingly bullish? We're talking a consensus strong buy rating here on a company that, when you look under the hood, is just hemorrhaging cash. It's this massive expected upside stacked right against a pretty grim financial reality. Let's start by meeting Sable Offshore. To figure this puzzle out, we really need to understand their underlying business model first. So, in plain English, what do they actually do? Well, Sable is an independent exploration and production company operating in the upstream oil and gas sector. They hold some pretty substantial federal leases, specifically focusing on the Santa Ynez unit out in offshore California. Their whole operation relies on extracting hydrocarbons and piping those resources to onshore facilities for processing. They're a niche player, sure, but they operate in a highly regulated and incredibly capital-intensive environment. Which brings us to the red ink reality. Now, what's really interesting about this is the absolute contrast when we pull back the curtain on the financials. On one hand, you've got the Wall Street consensus, a strong buy rating, and that $24 median price target, pointing to a super bright future. But on the other hand, you have the brutal reality of their first quarter 2026 earnings. They reported a massive earnings per share miss of negative $1.37. And guys, that wasn't just a tiny miss. The consensus estimate was a 64-cent loss. They literally more than doubled it. And the down and to the right trend here becomes painfully clear. We're looking at a company where net losses have just widened drastically. In Q1 of 2025, they lost $110 million. By Q3 of 2025, bam, another $110 million. And then in just the first 3 months of 2026, their net loss absolutely skyrocketed to nearly $200 million in a single quarter. The scale of this issue is just staggering. You can barely even see the revenue here. They generated a microscopic $1.27 million in revenue for Q1 2026, which, funny enough, was actually an improvement from their previous 0 revenue quarters. But stack that tiny sliver of income against a mind-blowing net loss of $197 million, the cash burn here is absolutely astronomical. So the core takeaway from their financial filing is this: losses remain large despite the company's growing asset base. See, Sable is in a very early stage, heavily capital-intensive build-out phase. They are spending millions upon millions just getting their infrastructure set up, but they just haven't established the profitable operations yet to cover that massive cost structure. And that means they are running on borrowed time. Because when you burn cash this fast, liquidity becomes everything. By the end of Q1 2026, their cash and equivalents sat at $52.2 million. Now that might sound like a decent chunk of change, but their short-term debt sits at an eye-watering $956.3 million. So for every single dollar of cash they actually have on hand, they owe an astronomical amount in short-term obligations. So the crucial point here is their debt-to-equity ratio, 232.2x. It means this balance sheet is incredibly leveraged. The company is running almost entirely on borrowed money. That is a frankly terrifying metric for an operation that isn't even generating meaningful revenue yet. So how are they actually staying afloat? Let's look at how they're financing this burn. First up, deeply negative operating cash flow. We're talking minus $82.2 million in Q1 2026 alone. Second, because of all that debt we just talked about, they have a massive interest burden. Just paying the interest cost them $34.7 million in that same quarter. That adds extreme pressure to their already weak earnings. And finally, to survive, they rely heavily on issuing new equity. Now, you might be wondering, why does issuing new equity matter to you? Well, because raising that capital comes at a huge cost. Back in Q1 of 2025, they had about 84.4 million outstanding shares. Fast forward to Q1 of 2026, and that number has jumped to 143.6 million. When a company rapidly increases its share count like this, it dilutes the stock. Basically, your slice of the pie gets smaller. That makes it way harder for retail investors to see strong earnings per share growth down the line, even if the company eventually does turn a profit.
So let's move to the high-stakes gamble and see how this all builds up. How on earth do we reconcile all this red ink, the looming debt wall, and the heavy dilution with that crazy analyst optimism? Well, the foundation of the Wall Street bull case is actually pretty simple. That borrowed money isn't just evaporating into thin air. It's going straight into massive infrastructure and asset build-out. Their plant, property, and equipment value has grown from $1.6 billion in Q1 2024 to $1.60 billion by Q1 2026. The analysts look at this and see a company successfully putting a huge physical footprint in place.
And there are some real external catalysts supporting this infrastructure. Just recently, a U.S. district court actually denied the California Department of Parks and Recreation's bid to block Sable from using a contested pipeline for oil transport. That is a massive regulatory hurdle they just cleared. It means their operations can continue, and it stabilizes their future oil supply. With that $1.6 billion infrastructure foundation set, analysts believe that once the switch is fully flipped on production, the revenues are going to flood in, hence those predictions of up to 195% upside.
Ultimately, this explainer really boils down to one fundamental contrast: the reward versus the risk. On the reward side, you've got a fully built-out $1.6 billion asset base, recent regulatory wins, and the potential for a massive stock rally if production scales up the way they hope. But on the risk side, you're staring down a terrifying wall of nearly $1 billion in short-term debt, microscopic current revenues, and the glaring threat of massive equity dilution just eating away at any potential returns. So I'll leave you with this final provocative question. Can Sable Offshore convert its massive capital investment into real revenue-generating production before their liquidity clock runs out? It is literally a race between operational execution and a crushing debt load. Do you have the risk tolerance for this extreme Wall Street gamble? Something to think about. Thanks for joining me on this explainer, and I'll see you next time.